Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of it should be relied upon as any form of personal advice. FP Markets does not know your personal scenario nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It is just general in nature only. Bit of volatility. Markets love to see volatility, particularly in our world with FX. And the rise of Omicron, the fact that transitory is not transitory anymore. Wow, what a shock considering we've been talking about that all year. And the fact that you are continuing to see very strong markers around getting through COVID better than expected is driving things through. Now, first and foremost, we need to highlight risk. Risk currencies are clearly going to be an area of concern if you are trying to go in a long position. If you have a look at basically last week when Moderna's CEO released the FT that he thought that the vaccines would be not as efficient as what they had been previously with Omicron, have a look at Aussie dollar. It fell 0.6 of 1 US cent just off that story alone. It's the same sort of story in New Zealand with the NZ. If you have also look at something like the Canadian dollar and having a look at oil, shows you very clearly that if there's any risks that could come around a new variant in the short term that create some forms of short-term issues, slowdowns, lockdowns, etc., that they are going to go to risk and they're going to sell off hard. You also saw that to havens. So have a look, dollar yen, it's one I've been really positive on most of this time. It reached a 5-year high 2 weeks ago. Did drop off 2 yen off the back of that story as well. So back into 113, it's pushing back up towards 114, but that 115 handle is gone for the moment. However, let's look at Powell and what Powell said. The fact that he has now had to say very clearly that QE might need to be wound up faster than expected. Again, shock horror, it's what we expected with the numbers that are so strong. But more importantly, changing the language around transitory, that is a big step. And that is certainly how the market took it as well. You are now talking about a Fed that is hawkish. You're talking about a Fed chair who is hawkish. And even though Lael Brainard now is his 2IC, it's clear that the board is having to play catch up to where the US is at because they are overstimulating their economy. That is true. Yes, COVID is having an effect, in particularly around consumption-led inflation, but supply chain issues to one side, economy is booming from employment, and non-farm payrolls again confirmed that on Friday, that even though they're at a level that are sort of mixing around a bit, they're still rapidly improving. The fact that 2 weeks ago jobless claims hit the lowest it's been since 1969 shows that there is structural elements inside of that, and that is what's driving us through there. It's why I've been talking about the US dollar for a while and why I still remain quite positive on the whole idea of it. It's because that economy is doing so much better than everywhere else. The central bank is having to move faster than anywhere else, and the flow of funds is going one way, and that is into the USD. Watch that space quite closely as we finish the year because we're almost there.